Very good morning to each one of you. How is everybody? Okay, great. I know you're all dying for a break. Thank you. Yeah, so after this, will be the break. So just stay with me for a while. Now, I'm sure, we have learned a lot this morning. And my job really is just try and put everything together so that you can take something away and try and execute it. Yeah? And the best way I can explain what has happened this morning is this. So you have heard an economist giving a market outlook. Yeah, a market outlook is like a weather forecast. So if you want to go out, sometimes you want to know the weather forecast, what is going to happen. Yeah, and then the second speaker talked about, if you want to get to somewhere, what are some of the ways you can get to your destinations? Yeah, and some of the risks involved and how you can prepare yourself. Now, you can make a choice after hearing the weather forecast that, you don't want to go out anymore. But if you do that, then you don't get a chance to be here and to listen to the various talks. Yeah, but if you want to go out there, then, knowing the weather forecast, you want to know how to better prepare yourself so that, if the rain comes or if it's too sunny, you are all well prepared. So my job here is, after knowing the weather forecast, after knowing the various ways you can get to your destination, how then we can put it together so that you can apply it and you can decide then whether you want to take, that venture out, the journey out to the destination that you want to go. So, 30 minutes. Like what the previous speakers have said, a lot to cover, so shall we start? Okay, great. Good. So, the title here is Managing Money, How to Navigate in a Rising Interest Rate Environment. I just want to show you something that's pretty interesting that I picked up over the internet just about 2 weeks ago. So, here's what happens when interest rate rise. It's actually really very simple. When interest rate rise, what happens? So, when interest rate rise, the higher interest rate will make bonds more attractive, right? Because the bond price will fall, so the bonds are now more attractive, and that is bad for stocks. But, the central bank in the US, the Fed, is raising interest rate because the economy is really strong. And actually, that is good for stocks. But rates are rising because inflation could be coming. And actually, that's quite bad for the economy. Rising inflation is the result of higher wages, and actually that's good for the economy. But if you get higher interest rate, that might slow down lending, and actually that's bad for the economy, right? What's next? Higher rate rises. If higher rate goes up, it raises interest income for those of you putting money in the bank, so actually that's good. But higher interest rate could also cause default because people cannot pay anymore, and actually that's bad. Higher rates could cause home prices to come down because it's more expensive to borrow money now to buy a home, and that's good for buyers, okay? Because home prices drop, it's cheaper for buyers, right? But at the same time, higher rates could also hurt home prices if you are a seller, so that's bad for seller. Higher rates could cause the dollar to strengthen, and that hurt exports, for the US. But a stronger dollar could make imports cheaper, and that's also good for the US. Cheaper imports hurt domestic manufacturing, and that's bad. And by domestic, I mean the US. And rushing manufacturing to lower cost region helps consumer because you get cheaper things, and that's good. And high rate makes bond prices fall, and that's bad for pension fund. And I don't specifically mean our CPF. I mean pension fund in general, because a lot of pension funds are pegged to bonds, and so bond prices fall, that's bad for pension funds. What else? Higher rates increase the discount rate pension used to calculate future liabilities. That's good for pension funds. High rate gives the Fed room to cut during the next downturn. That's good. And high rate have caused most downturn, and that is bad. And you continue this exercise until you go crazy. But that's the fact, right? Because it's so difficult. I mean, each time we hear this, there are always the pros and cons, to everything that happens in the economy, in the market, in the short term. And it's just so hard to make up what it is. Sometimes when I read this, the Hokkien calls it, and I know there are non-Chinese here, and I'll translate to English, but the Hokkien calls this, 无讲跟那无讲. Means God say like never say. Because after you read all this, you go back and say, so what? So what does it mean for my investments? Because everything that changes in the economy has got a pro and con. So So what do we do? What do we do actually as a normal investor, as a man on the street? All these interest rate rises, all these trade wars, all this crawling between countries and all that. So how do I, as a normal investor, as a man of the street that I don't have millions of dollars, I'm sorry, I'm assuming you don't have millions of dollars, maybe you have, okay? But I'm assuming most of us don't have. How then do we actually invest? How then do we actually save? So I want to keep it very simple, and I'm sure we all understand it. Firstly, of course, we always try to increase our inflow, right? And then, of course, how do we increase our inflow? We do it through savings, simple savings. Yeah, we try and find instruments that give us a higher interest rate, especially in an environment when interest rates are going up. We try and decrease our outflow. And one of the biggest outflow in our financial life are debts, especially home loans, mortgage debt. And in an environment whereby interest rates are going up, I'm on a floating rate. My mortgage is on a floating rate. Every few months, I get a letter from the bank telling me that the interest rates have gone up. Yeah. So one of the ways you might want to consider is to lower your debt by perhaps considering fixing your mortgage rates. And I say considering, because it's very hard. I mean, given 30 minutes, it's very difficult for me to put down what are some of the things you might consider. But you might want to consider if you are afraid that, the interest rate keeps rising and your monthly mortgage payment keeps going up, you might want to go and explore with your bank, whether it would be good for you to fix your rate. But however, sometimes the floating rate and the fixed rate is so far off that it might not make sense for you to fix the rate. For example, I just did a scan on the internet. Some of the banks are fixing rate like 2.4%, and currently you are paying like 1.7% for your mortgage. It seems so far away. So there are a lot of consideration, but what I'm saying is that if you are fearful that the rising interest rate which cause your mortgage rate to keep going up and you are uncomfortable with that, one of the things you might want to consider is to fix your mortgage rate. And if you have monies in the banks that you're not doing anything about it, you might want to even consider paying some of your mortgage or some of your loans off, because as interest rate goes up, you are paying more and more interest. So firstly, you try and increase your inflow by looking for savings account, instruments that can give you a higher interest rate, because interest rates are going up. A lot of things are a lot of instruments, a lot of saving accounts, the interest rates are also going up. So it's a good thing. So you look for all these accounts whereby you can put your money, or instruments where you can put your money, whereby you can get a higher interest rate. That makes sense to all of us, right? Secondly, you try and reduce your inflow, pay off some debt if you can, if you have got cash, not doing anything about it, or you try and lower your debt by fixing it, consider that. And of course, if you are investing, my suggestion to all of us as long-term investor is that you ignore all the noise. And I'll talk more about that in a short while. So I want to quickly talk about Singapore Savings Bond. I know that it has been spoken by the previous speaker, but I just want to go a little bit more into this, because just now when you were doing all your votes, I realized that Singapore Savings Bond is one of the instruments that most of us don't do it. Least number of people actually invest or buy into Singapore Savings Bond. Now, in an environment like this, when the interest rates are going up and you're looking for places to put your money, yes, you can go and put your monies in the various banks. Nowadays, the three big banks in Singapore are all offering special bank accounts that give you a higher interest rate. You have DBS Multiplier, you have UOB One, you have OCBC 360. All these banks are giving you a high interest rate. But of course, with all these high interest rates, there are certain criteria that you have to fulfill. And also, there is a maximum you can put. I know some banks limit the account to be like 70,000. Beyond that, you cannot put in those accounts anymore. And as I've mentioned, from the look of everyone here, all of you here got more than 70,000, right? So after you put in all these bank accounts, you got some more cash. You don't know what to do with it. One good instrument that you can consider is the Singapore Savings Bond. So very quickly, if we are not familiar with the Singapore Savings Bond, let me explain what's the Singapore Savings Bond. Now, the Singapore Savings Bonds, or the SSB in short, is interesting because it's not really a bond. Because this is an instrument that you cannot trade in the secondary bond market. You cannot buy and sell to another buyer. Look at this like a saving instrument, And what you do is that you are actually lending or saving with the government. Put it that you are saving with the government, and it is a 10-year saving plan, And this 10-year saving plan is very, very interesting because unlike bonds, let's say you save $1, okay, let's say not $11, okay, it's $1. Let's say you save $1, okay, and the interest rate actually goes up every year. It's not flat. Okay, so the interest rate or the coupon rate goes up every year. So let's say the first year, you get a 0.9% interest. The second year, you will get it higher, 1.5%. The third year, you might get higher. Fourth year, and every year it keeps going up until the 10th year, you probably get the highest. Okay, and at the end of 10th year, the government gives you back the $1. Yeah, and if you add all these interest rates up, okay, if you add all these, because the interest rates are going up every year, right? If you add all these interest rates up and you divide it by 10, you get an average of, say, about 2.5%, depending on which tranche you buy. Am I clear so far? Yeah, the interest rates are step up. It's escalating interest rate. So the longer you keep, the average interest rate is higher. Okay? Now, can you lose money with the Singapore savings bond? Yes or no? Can you lose money with the Singapore savings bonds? Yes or no? Okay, I can't say no, but very unlikely. Okay, very unlikely. Unless, of course, the Singapore government goes bankrupt, right? Because you are lending in a way, you are saving with the Singapore government, and, well, unless the Singapore government goes bankrupt, it is unlikely you will lose your money with the Singapore savings bond. But is it possible that the Singapore government goes bankrupt? I have asked this question many times. Is it possible? Yes or no? I know this is run by MAS, Stock and CRs, but you can say it. Can the Singapore government goes bankrupt? Yes or no? It is possible. If you say it's not possible, I will always say, let's all stand up and sing Majula Singapura. Because you're so confident. I mean, technically speaking, it is possible for every government to go bankrupt. But what are the chances of the Singapore government going bankrupt today? Yes? High or low? High or low? Wrong answer. The correct answer is, it depends on how you vote in the next election. I didn't say which party. I only say it depends on how you vote in the next election. Because it is true, isn't it? That whoever manages the money up there must manage it well. Otherwise, it is possible for the country to go bankrupt, right? But in the short term, it's quite unlikely. I mean, it's quite unlikely that the Singapore government will go bankrupt. So it's pretty safe, unlikely. And there are no currency risks because the Singapore savings bond, you're putting in Sing dollar. There is no currency risk for you. So no risk in that area. And it is capital guaranteed, like I say. And the good thing about the Singapore government or the Singapore savings bond is that you can sell anytime you want. You don't have to wait until the 10th year to sell. You can sell on the first year. You can sell after 1.5 years. You can sell after 2 years and 3 months. You can sell anytime you want. And you will always get your $1 back. And whatever interest that you have not gotten, it will be prorated to you. So it is a very safe instrument, and if you have got money, cash in the bank, after you have put in all the savings account and you still have cash, this is one instrument that you might want to consider because it's safe, it has liquidity. The longest you have to wait before you can take out the money is 1 month. And so it's a pretty good instrument to put in right now. Okay? Take a look. This is the December tranche. You still have chance to buy. The closing date is on the 27th of this month, 9 p.m. Okay, you can only buy it over the 3 big banks ATM or your internet banking. Okay, but you cannot buy after 9 p.m. Okay, so you want to buy, please buy before 9 p.m. 9 p.m. you want to buy, cannot buy anymore. To buy, you have to have a CDP account. Okay, I can't see the age group here, but if you are young, as long as you are 18 years old, you can open a CDP account and you can buy this bond. Okay, this is the December tranche. Okay, so look at it. First year coupon is 1.89. Can you see? Somehow there is no light here. Okay, but if you see interest for first year, right at the top is 1.89. That is your first year interest, yeah? Yeah, and the second year is 2.19. Third year is 2.38. All the way until the 10th year, you get 3.04, yeah? And if you add the top numbers together, you get an average. So the first year average is 1.89. The second year average is 1.89 plus 2.19 divided by 2. So you get 2.04. Average. Are we okay so far? So if you look at it, it's pretty nice, right? I mean, 1.89 first year without risk and sell anytime is pretty good. Yes? Just one caveat, okay? The interest rate, the 1.89% that you get out is not compounded. The minute the 1.89 is paid out, and it's paid out twice a year, 1.89 divided by 2, twice a year. Once that money is paid out, you keep it in your pocket or in the bank, it is not reinvested into this bond. So you don't get the compounding effect. Are we okay so far? The pointer, yeah. Oh, it works, but it doesn't show here. Yeah, thanks. Okay, so that's the Singapore government bond. As I said, I've said enough, yeah, but it's good for all of us here if you want something safe. And in a rising interest rates, 1.89 is the highest we have seen so far for the SSB from what I can remember. I've never seen a SSB first year 1.89. So it's pretty good if you have not done it. So after I said this many times, I expect this issue to be oversubscribed. Yeah. Now, the second instrument in a rising interest rate environment is a normal bond, which has been covered as well by the previous speaker. By a normal bond, I mean these bonds are traded in the secondary bond market. Okay? It could be a government bond or it could be a corporate bond. Yeah? So, of course, in Singapore, the latest bonds that we've just seen being launched, and it was all snapped up 8 times oversubscribed, would be your Temasek bond. And the Temasek bond is paying a coupon of 2.7%. Okay, very good. In this interest rate environment, very good. And especially for a Temasek bond, very safe. You don't expect it to collapse. You get 2.7%. People know it's not bad. It's 5 years bond, and that's why it was snapped up. Now, how does a normal bond works? Okay, same way. Let's say you put $1, ignore the 11. Okay, I don't know how come it became 11. I put 1. Okay, so let's say today you are buying a normal bond, but it's in US dollar, and that bond is $1 to buy. But you don't have US dollar, right? So you got to change it to US dollar, right? So imagine this. Okay, it doesn't really work like that, but imagine this. You have Sing dollar, you want to buy $1, so you go and walk to the foreign exchange person, and you say, I want to exchange for $1. And imagine today that the US dollar is 1.8 Sing to 1. It's not so high, but let's assume, okay? So let's say today, okay, let's use the easy number. Let's say today, for every 2 Sing dollar, you can buy $1, yeah? So you go to the foreign exchange guy and you give that guy 2 Sing dollar and you get $1 and you buy this bond. And every year, you get a 5% coupon, semi-annual. It pays 2.5% every 6 months, and it pays you for 10 years, and at the end of 10 years, you get your $1 back. Are we okay so far? That is a bond. It's an IOU. Okay, you're lending to this government or you're lending to this company. So you get a $1 back, and then now you got a $1, you walk out, and you want to go and eat your roti prata. And you cannot buy roti prata with US dollar, right? So you got to change back to Sing dollar. So that is where the FX risk is. Can we see that? So if you buy this kind of bond, can you lose money? Possible or not? It's possible, right? Of course. How? Firstly, the company can go bankrupt. The government can go bankrupt. Secondly, there is a currency risk here. Because now you got your $1 back after 10 years and you want to eat roti prata and you go to the FX guy to change it, it is no longer 2:1. Now you take the $1 and you change it, and maybe the US dollar has weakened and you only change back, 1.5 instead of 2 Sing dollar that you paid. And there is the currency loss. Okay, and also, it is possible that you will lose money if you need to sell at the wrong time. And what do I mean by selling at the wrong time? In a time like this, when interest rate environment is going up. Because when the interest rates are slowly climbing up, what is happening to the bond prices? It's falling. Why is it falling? Firstly, give an example. Let's say, impossible. I'm using ridiculous numbers so that we can remember, okay? So let's say this bond is a 5% coupon bond, but the bank interests have gone up to 7%, let's say. And you are in a hurry to sell your bond, surely nobody is going to buy this bond from you because it's only paying 5%. They might as well put it in the bank and get 7%, yeah? Yes or no? Yeah, so if you want to sell it, you got to sell it what? Cheaper. Because otherwise, nobody will buy from you. You cannot sell it at $1. You bought at $1, there is no way you can sell at $1 because nobody is going to put the money. Nobody is going to give you that $1 because they might as well put it in the bank at 7%. So say, for example, in order to make it worthwhile for the person to buy, you have to sell it at 80 cents instead of the $1 that you put in. Why? Because for the buyer that buys it, if he buys it at 80 cents, he knows in a few years' time he's going to get back the $1 and he's going to make a 20 cents profit. Okay, and this is 25%. And assuming that the minute you buy, you buy, interest rate goes up. And the next month you have to sell. So there's about 10 years, another 10 years before the bond mature. So you take 25%, you divide by 10 years. Simple math, okay? This is not, for those of us who are financially trained, you know this is not 100% accurate. I'm just doing simple mathematics. It is about 2.5% a year return for this guy who buys it cheaper. And plus the 5% coupon that he's going to get about 7.5% per year, which is better than the bank of 7%, right? Then he doesn't mind buying it from you. But you would have lost 20 cents of your capital. Can you see that? That's why when interest rate goes up, there is a chance that your bond price will drop. What am I saying this? Now, while it is good right now in a rising interest rate environment, and I've asked you, increase your inflow, go and buy the SSB. Another instrument, yes, you can go and look at all these bonds because the bond yields are going up, the coupons are going up. It is good. Go and buy the Temasek bond. Version 2, maybe there's going to be another one that comes, I don't know. Yeah, but be mindful that in an interest rate rising environment, a rising interest rate environment, if you need to sell at the wrong time, you might lose money. So if you're buying, it's okay if you're going to keep for the full 5 years. It's okay if you're keeping for the full 10 years. That's okay. But if you need to sell it in the short term, you might lose money. Are we okay so far? Yeah. So increasing your inflow, but beware of the potential risk in a rising interest rate environment. Lower your debt. And the next thing I want to quickly touch on, okay, is in investing. Now, so as I mentioned, right, giving you a market outlook is like a weather forecast. And how you use the weather forecast is very important. Okay? Now, let's say you listen to all the weather forecasts, or you listen to all these things that are happening out there, interest rate going up, trade war, fighting among the Middle East, all these things that you hear, and you try to beat the market. That means you try to find time to get in and out based on what you hear and what you analyze. That's called trying to beat the market, yeah? That's like trading. Am I okay so far? Yeah. Now, if you try to beat the market, it is actually very difficult to do so for most people. Even for the professionals, it's very hard actually to try and beat the market. But if you still believe in beating the market, and I'll explain beating the market a bit more in a short while, but if you try to beat the market, consider this study done by this guy called Michael Marbacin. This was a big guy. He was an ex-chief investment strategist of a very big fund house. And he did a study of the S&P 500 during this period, 1978 to 2007. He found that the average return up and down over the 10 years, or over the few decades, was about 9.5% per year on average. But if you are so good and you are able to siam the worst 50 years, that means every time before the market crash, you are so good, you got a crystal ball, you are snapshot accurate, you got out already. Your returns double. But whilst trying to siam the market, you wrong, you salah, and actually the market is going up, then your return might drop to 1%. Are we okay so far? That was what exactly happened over the last 2-3 years. Yeah, because, there were news of Brexit that's going to affect the market. There was news of the US election, all that. And if you have gotten out of the market the last 2 years, you would have missed the return because the market didn't really go down. It went up. Yeah? So that's what trying to beat the market is. That's what beating the market is about. And it's not easy. Okay? And you do it wrongly, your return is going to suffer. Then there's a second study done by this guy. He's one of my favorite authors in investments. Buy the book if you would like to read it. It's called The Random Walk Down Wall Street by this professor called Burton Malkiel. He did a study of the markets in 54 years. He realized that the market has gone up 36 years, flat for 3, and only down for 15 years, which means to say, actually, most of the time, the market is up. Now, what does it mean if you put these two studies together? If you put these two studies together, it tells you that if you try to beat the market, if you are wrong, you are in a very bad shape. And the chance of you trying to siam the market because it's coming down is 3:1 against you, because actually, most of the time, the market is okay. The market is going up. Yeah, and this is a very stressful way to invest. As I've shown you earlier, what happens when interest rate goes up? It is very simple because there are so many things that are happening, right? It's a very stressful way to invest. For a man on the street like us, it is actually very hard to guess what will happen to the market when certain things happen. You understand what I'm trying to say? Yeah, so actually you don't really have to. Okay? But if you still believe, yes, you can try and beat the market. Let me show you some data very quickly, okay? This is a study of active versus index. Let me try and explain index very quickly because I'm not going to assume everybody understands this word index. Index equals market. So when you talk about the Singapore market, is usually represented by which index? Straits Times Index. And the Straits Times Index constitute 30 big stocks. Okay, a lot of them are, your banks, your telcos, your Singapore Airlines, and all that. Yeah, so these 30 big stocks, of course, they are not all the stocks on the SGX, but these 30 big stocks, they are 30 big companies. Every day, on a daily basis, some of these companies, the stock will do well, some of the stocks will not do as well. But on average, if these 30 stocks, collectively, they do well, then it represents the Singapore market, and you can generally say that the Singapore market has done well. Are we okay? So if you look at the US market, a popular index will be your S&P 500, which constitute 500 stocks, of course. You have your Johnson & Johnson, you have your Coca-Cola, you have your Apple, and all these big companies that we have heard of. Yeah, and on a daily basis, some will go up, some will come down, but collectively, if these 500 stocks go up, then we can say that the S&P 500 representing the US market, it has gone up. That's the index, right? So if you try to beat the market, what you're trying to do is that you are saying that, actually of these 500 stocks, or for STI, of these 300 stocks, which one will do well, which one will do badly. You try and pick the stocks that will do badly. Maybe you'll pick 10 stocks out of the 30 stocks that will do well, and the remaining 20 in the STI will do badly. And if you are very good, you beat the market. Okay? Or, in picking the 30 stocks, sometimes you buy these stocks, sometimes you sell these stocks, or sometimes you totally don't buy into the stocks, you buy into bonds, you get in and out all the time. You are also trying to beat the market. Are we okay? So, if you are doing that, then you are an active investor. Okay? And there are unit trusts, they are actively managed, meaning to say they try to beat the market. Now, this is a report card of how difficult it is actually to beat the market. So if you look at the 1, 3, 5 year, 10, 15 years return, you will see the blue ones are active, the red one is the market. You will see that actually many managers find it very difficult to beat the market. Most don't. It's not easy. Can you see that? Over the long term, even the short term, 1 year, most don't beat because it's not easy to beat the market. This is the US market. If you look at the emerging markets, you have your Brazil, Russia, India, China. It's the same story. It is very difficult for the active managers or active investor to try and beat the market, to try and guess the best time to get in, get out, which stocks to buy, which stocks don't buy. It is very difficult, not easy. Yeah? This is the same data. Most stocks managers find it very difficult to beat the market. Most bonds managers find it very difficult to beat the market. But I know what you are thinking. You are saying that, yeah, but Chris, I know it is very difficult to beat, but some beat what? So just find those that beat lah. It is difficult to also find those that consistently beat. So if you look at this data, 2014, we find the 517 fund managers, they are the top 25%. That means they are the best performing top 25% fund manager. 1 year later, only 174 of these 571 remain top 25. And by 2018, only one out of the 571 maintain their position in the top 25. It is like, and I've said this quite a few times, you've attended my talks before, you know I say this many times. It is like when I was in primary 3, I was third in class. And I used to stay in a HDB block, you know those 3-room flats, slab block, one whole corridor, 20 over neighbors. I bet every single neighbor knew that when I was in primary 3, I was third in class. Because my mother was so proud that she must have gone around in her humble bragging way, telling them, my son, Tesamia, I know, third in class. And you know what? If you had bet your money on me, you would have lost big time, because that was the only time in my life. Why you laugh? That I was ever top 10. I was never ever top 10 again. For some reason, that particular year, the blind chicken kena the worm. And I was third in class. I was lucky. It is really difficult to be able to consistently outperform the market. That's what I'm trying to tell you. Okay? And actually, you really don't have to. Okay, the second speaker has alluded to that. Actually, you really don't have to. Okay? If you are investing for the long term, you just have to stay invested because you get the average return of the market. It's a lot less stressful because you don't have to guess, but there's one condition. In fact, I want to add there are two conditions. The first condition, also the second speaker has alluded to, you cannot buy one stock. You buy one stock and then it goes down, and then you say that, I come to Money Sense Stock, they say stay long term. And you stay, and you stay, and you stay, then the company go bankrupt already, you still staying. It doesn't work if it's just one stock, right? So you have to buy the entire market. You got to diversify across many, many, many stocks. Buy the entire S&P 500, buy the entire STI. Some of the companies will fail, but you don't expect all the 500 companies to fail. Some of the names are big names like Coca-Cola. You still drink Coca-Cola. Your kids still drink Coca-Cola. No matter how good or bad the economy is, an iPad still gets sold. People still buy iPhone. A few days ago was my birthday, and my son bought me an Apple Watch. Apple still sell products. Right? So the companies some will die, but most will still be there. So that's the first condition. You cannot just buy one stock. The second condition is you must have time. And all of us here, you have time. I can see. You are all going to live beyond 99 years old. But joke aside, it's true. Singaporeans are just living longer and longer, right? And you surely cannot just put all your money into bonds and Singapore savings bonds and into your bank, because it's just not going to be enough to beat your inflation. There will be some parts of your money that you need to invest for the longer term, because it will beat the inflation for you, right? Yeah, and you have time. You have at least 10 years. And why do we keep on saying you must invest long term, 10 years? I need to switch to my PDF. Hello. I need to switch to my PDF. That PDF, yeah, can you help me? Okay, I'm going to show you something that is very exciting for me. I don't know whether it's exciting, but I have to warn you, very, very little things excite me. So maybe I'm excited, but you're not excited. So I want to show you something that it excites me as an investor, as a man on the street investor. This excites me because from now on, I don't have to guess. I don't have to guess whether the market is going to go up, the market is going to go down. I don't have to guess anymore. Okay? So, can you all see the numbers there? What do you mean you cannot see? They're all there. Okay, I'm going to enlarge the number. I hope this works this way. Okay. Can you all see? Better, right? A bit more. Can see? Okay, so this is the table for the annualized return, average yearly return of the S&P. I keep using the S&P 500 because the S&P 500 constitutes 52% of the world equities market. It's the biggest market in the world. Yeah, so if you invest in the S&P, I'm not saying just only invest in the S&P, don't get me wrong, I'm just using the index as an example. But if you have invested in the S&P 500, you basically invested 52% of all these big listed companies of the world. Yeah, and so this is almost 100 years of data, okay? How many of us here born in 1926? If you say you are born in 1926, I'm a bit scared. Because I don't know whether you are human or spirit. Okay, no, I'm just kidding. Okay, you are born in 1926. Assuming you are born in 1926 and you invest, okay, can you see my little red dot? Can see or cannot see? Can. So if you invest in 1926 and 1 year later at the end of 1926, your return from the S&P 500 would have been 11.6%. 2 years later, your average return would have been 23.9% per year. That means cumulatively you have gotten about 48%. You understand what I'm saying? 3 years later, your average return per year would have been 30% a year. And if you remember 1928, what year was that? It's the Great Depression. The market crashed, right? So you see 1929, 19.2. Can you see 19.2? I can't find my light. Ooh, where's my light? Okay, 19.2%. Can you see? So you can see 19.2% average per year. Okay, so the markets have fallen, and it will fall some more 8.7. And by 1931, the average return per year for the past 6 years is negative 2.5% per year. And by 1932, it's negative 3.3 per year. That's how you read this chart. So when you see red, the annualized return, the average return is negative. When you see black, the average return is positive. Are we okay so far? People? Yes? I don't have much time, so I'm going to move very fast, okay? So, if I move all the way back to, I want to show you something closer to us so that we get a sense of it. So if you see here, can you see year 2000? Do you remember year 2000? Y2K, internet bubble burst, remember all those things? Red, okay? And then if you see 2008, remember the GFC, global financial crisis? Can you see negative 37% for that year? It was really bad. Yeah, I was managing money during that year. It's really scary. In 3 months, the stock market kept falling. Nobody know what was happening. It was really scary. That was the year, September 2008. Okay, so if I zoom out, and this is what I'm going to do, I'm going to move back to my PowerPoint. Where's my PowerPoint? Which one is my slide? Okay, this one. Okay, and can you put the slide mode for me? Thank you. Okay, so if I zoom out, this is exactly the chart. What I did was I just go and color the negative years to be red. The pink means still negative but single digit. The dark red one is bloodbath, means double digit negative. The dark green means double digit positive. The light green means single digit positive. Can you see? The first thing you see is it good or bad? You feel so encouraged, don't you? Because the world is not so bad. Every year you hear bad news, but most of the time you see green. Do you see green? And the red, where are they? They are only at the edge. What does it tell you? In the short term, be prepared, you might get red. Okay? There are some short-term years that don't even have red. You invest during this period, boom town Charlie, man, all green. If you invested this period, green. This period, these are roaring 90s, green. Yeah, only some patches got red. Okay, I don't have a line. I don't think I have a line. I don't have a line to show you, but if I draw a line, okay, and to be parallel to this edge here, that means to say I put a line here that covers the last year whereby there's a red. It's somewhere here. And I draw a line parallel downwards like that. Okay? Anything behind this line, around this area, the upper edge area, you will find a red. But once you cross that line, there's no more red, all green. And if I count the number of years to the line, before you get all the green, is 14 years. That includes the Great Depression. But if I take away the Great Depression, I can move the line slightly higher. It's about 10 years. Meaning to say that as long as you stay invested in the S&P 500 for 10 years, beyond that, you never get a year whereby your annualized return is negative. I have to say a caveat or a disclaimer, okay? This is when you put $1, a single investment. Okay, a single investment. But it still works for regular savings plan. Okay, but this data is for single investment. You put one time. Isn't that good news, people? Isn't it good news? All you need to do is tong. You will be fine. You will be fine. You know, it was 2006. My sister, I got 3 sisters. I got 3 other siblings. They're all sisters. I'm the only guy at home. I'm not a pet, don't worry. My 3 sisters came to me in 2006, thereabout, and they said, "You are the one that is financially literate. Invest money for me." The first reply I gave them, no, don't want. Win money, never thank me. Lose money, blame me, don't want. They said, no, you got to help us because otherwise nobody's going to invest for us for retirement. So, no choice, I took their money. Every month they gave me $1,000. $1,000 a month can't buy a lot. So I accumulate. And when there is enough money, I just buy the S&P 500 ETF. That's all. Of course, subsequently, if you got more money, you can add on other markets, emerging markets. But they only had so small, so I just bought the S&P 500 index. So that was what I did. Every few months, I'll buy one time, and all that. When 2008 hit, the market crashed. I forgot about their money. I told them, stop, don't give me. Too busy. I was busily running the firm. I was facing the client every day kena scolded one. Right? So I was really working very hard, stressed. I forgot totally about their money. About 2-3 years ago, I can't even remember when, my second sister came and said, "God, you remember the money we gave you?" "Oh no, yes, I forgot." And so I went to check. Their portfolio has gone up by 100%. And they looked at me. I was a hero. "Oh, you're so clever, huh? You make a lot of money." They went around telling their friends, "My brother helped me make so much money." But in truth, I wasn't a hero. I just forgot. because had I remembered, I might have sold it. Because, you know what? Which is probably the last thing I'm going to show you here. The problem with this approach is that while the head understands, the heart cannot connect. Because you're going to leave this conference, you're going to leave this seminar, and you're going to say this, I know Liao. I just go and buy all the index and I tong. And then you're going to read the newspaper, and your friend is going to tell you, the taxi uncle that drives you, just now I came by a taxi and the uncle told me, market going to crash, Liao. And the common statement you will hear is, you know, this time is different. It's true. Every time is different. Every time, the things that cause the crisis cannot be the same. Every time there are different things, although usually it's debt-driven. But you know what is the same? What is the same is that the thing that drives stock prices is profitability of the company. And as long as the company remains there, and as long you need to eat, you need to use handphone, companies will be there. Some years it will be good, some years it's going to be bad. But overall, it's going to be okay, as it has been shown over the past 100 years. And all you need to do is you tong. And if your head and your heart cannot connect, don't just buy equities, because buying equities is like sitting on a roller coaster like Battlestar Galactica in Universal Studios. Your heart cannot take it. And if your heart cannot take it, you press button and you jump down. And that's where you lose money. So if you know that your head knows how to tong, but the heart tong wei diao, what do? Maybe you should go and buy some bonds. Because what bonds do is that they make the ride smoother. That's what bonds do. Yeah, over the long term, bonds make the ride smoother. So when you put bonds in your portfolio, it's like now you are sitting on the Shrek roller coaster in Universal Studios. Smoother ride. You can tong and you can finish the ride. Yes, it's not so exciting. Yes, the returns will be lower. But at least you can finish the ride. Rather than you tong, 100% equity, and then your heart cannot take it. And even if you tong until the end, the money is there. But you are already upstairs. Because heart attack. That's how you make your head and the heart connect. You know the market is going to go up over the long run. The stock market goes up in the long run. You know you have to tong. But you can't tahan, right? Then you put some bonds inside there. Okay? I don't have time already, but this is what I'm trying to say. Okay, so for a conservative portfolio, sample, please don't take this picture and then go and buy exactly. This one is I anyhow hantam one. Because I was very late, I sabo MAS and CS. I gave them like 2 days before. So I last minute Gabra anyhow put the number one. So don't go and take picture and go and buy exactly, okay? But what I'm trying to tell you is, if you are very conservative, you hard way side tong one, cannot tong, then you put more money in bonds, you put lesser in equities. But you are very aggressive, you can tong. Okay, then okay, you put a lot more in equities, but be prepared. Along the way, the next 10 years or so, you're going to vomit, puke. Okay, because the world for the next 10 years, you're going to invest for 10 years, you cannot expect the world to be peaceful, right? Every year there will be people quarrel, Trump quarrel with this fella, people North quarrel with us, all that. Every day people quarrel one. Okay, happy, I don't want to sell you, things like children quarrel like that, no? Yeah, I don't want to sell you, you don't want to sell me, that kind. There will be, and because of that, the stock market is going to go up and down. Yeah, but if you are the type that, I can tong one. Because my money all safe, I got a lot of money saved. Then okay, you go for the aggressive one. Yeah, but otherwise, put some bonds in it, the ride will be safer. Last slide. I just want to show you this chart that shows this is a 60%, 40% portfolio. It's a 60% equity, 40% bonds portfolio. And look, it's still quite nice. It might not get the return as high as you wish, but it is still quite nice. So let me just end my session by saying this. There will be a lot of weather forecasts you will hear. And it's good to hear them, to be prepared for what is to come. However, for investors like us, let's keep it simple. If interest rate is going up, go and find an account that put your money in to get a higher interest. Look for Singapore savings bond, just go and buy it to get high interest. It's safe. Just vote carefully, but it's safe. Okay? If you're going to buy bonds, that's fine. But please don't sell at the short term, because if the interest rate is going up short term, you may lose money. Make sure you let it mature. If not, don't buy. And if you are investing, okay? Ignore the noise. Okay? Ignore the noise. I'm going to just go very fast. This is nothing new. Just a summary of all my points. Warren Buffett has this to say. He says the up and down of the market in the short term does not reflect the real value of the company. The ups and downs of the market in the short term simply reflects the greed and fear of investors. When investors are fearful, the stock market crashes. When investors are greedy, the stock market goes up. And so you should ignore this. 2 weeks ago, the market fell, right? And it was really scary, and there were a lot of calls to sell. This was what we told our clients, don't sell. In fact, if you got some spare cash, put some in. True enough, last week, the market went back up. So I've got a sure win strategy for you. You want to listen to a sure win strategy? You take out a pen and write this sure win strategy, okay? Every month, every few months, just buy some. So you got $1, right? You just buy some. Take 80 cents, just buy some. Don't go and guess. Don't go and guess. Just buy some. Okay? Then you leave the 20 cents. There's one thing I can tell you. Okay? I'm a very well-known market forecaster. Let me forecast for you the market. The market will crash. I just don't know when. And when it does, buy some. Sure win one, because we never know. Imagine these people. 1 week later is the Trump election. Let's say we go back 2 years. 1 week later is the Trump election. An analyst says that if Trump wins, the market is going to fall. If Hillary Clinton wins, the market will go up. You don't know what to do. Your fairy godmother appeared to you in your dream and say, people, you have been good boys and good girls. I'm going to give you a gift. Trump is going to win. You trust your fairy godmother. Next morning when you woke up, you sell all your stocks. Your fairy godmother didn't bluff you. Trump won. But the market didn't drop. It's very difficult. And there is no need to. Okay, with that, thank you very much. Enjoy our break. See you in a short while.